So what is a trust fund? A trust fund refers to the assets held inside of a trust. Now let's take a look at each word. First, trust. A trust is simply a legal document that is written to hold property for another party's benefit. Now the fund. The fund consists of the assets held inside of the trust according to the trust terms. So the fund could be a bank account, stock market investments, and/or real estate the trust owns, for example. That is a trust fund. Hi, I'm the Business Guy, and I've been in the trust formation and asset protection business since 1991. Our company started in 1906. We have attorneys on staff who are experts in trust formation. So if you want to set up a trust, please call or visit our website below. And I also work hard to put this information together. So if you could please click the like button and share this video with others, it would help YouTube promote this video. Thanks very much. And on this channel, we try to get to the point and give you big value in little time. So please click the subscribe button below so that when other videos come out like this, you'll get notified. While the term trust fund conjures up images of high net worth individuals, middle class people are increasingly turning to trust funds so their estates avoid probate. Now that's the legal process of transferring assets upon death. And the trust can avoid all the lawyers and judges and legal fees so that you, instead of a judge, controls how your heirs receive your assets. Setting up a trust fund is one of the best ways to ensure financial security for your loved ones. This is because a trust can reduce estate taxes, eliminate probate, make investments, and schedule monthly distributions to yourself or your loved ones. Most importantly, certain types of trusts can protect your assets from lawsuits. After all, if a greedy law firm plunders your wealth, the above points are moot. Moreover, a trust can provide these benefits during your lifetime and long after you've passed. So here we will discuss these advantages in detail. The bottom line is, no matter what your net worth, you can create a trust fund to provide financial security for yourself and your loved ones. Incidentally, you can even use a trust to protect themselves from themselves. That is, if you feel your heirs may not handle their inheritance responsibly, you can set up a trust fund to address those issues, such as making monthly distributions rather than having them blow through a big lump sum by having them buy a fleet of Ferraris in every color. Thus, with a trust fund, you can distribute your assets the way you would like. What's a trust fund baby? A trust fund baby refers to a person, especially a younger individual, for whom a trust was established that provides sufficient income so the individual does not need to work to earn a living. Parents or grandparents typically establish such financial arrangements in trust that provide for the living expenses of a child, grandchild, or other individual. For example, I knew a young man who was an heir to the farmer who invented the baby carrot by simply cutting regular carrots into 2-inch sections and rounding each end. As I recall, he received regular income from the trust fund that will last a lifetime. Now, the stereotypical image of a trust fund baby is that of an individual living a high society existence without putting forth the entrepreneurial exertion required to produce such a lifestyle. People envision the individual driving exotic cars, jet-setting around the globe, and going on exotic vacations. In truth, according to thecut.com, those who receive trust funds represent fewer than 2% of the U.S. population. Moreover, the median amount received, they continue, is only about $285,000. Most, but not all people who are the beneficiaries of trust funds still need to work. The trusts simply provide a single lump sum payment or ongoing supplemental income. Those who leave substantial estates behind often insert what is called a spendthrift provision into their trust. That is, a trust appoints a trustee who limits the trust's financial outgo. Those with forethought often structure this arrangement to prevent young people from spending foolishly and burning through their inheritances. Most popular trusts. Among the most popular tools to create trust funds are inter vivos or living trusts. We call these tools revocable trust. This means that the owner can make many sorts of changes to the trust during their lifetimes. That includes changing or adding beneficiaries, moving assets in or out of the trust, and once the trust owner dies, however, the living trust becomes irrevocable. Its provisions are not subject to change at that point. A living trust does not hold significant income tax advantages. It can, however, have significant estate tax advantages for the trust fund recipients. This is because the trust can divide assets into two subtrusts, Subtrust A and Subtrust B, for example. one for one spouse and one for the other. Typically, it works this way. When one spouse dies, the other spouse has full access to one of the subtrusts. The surviving spouse can access the income that the other subtrust provides. When both die, this arrangement doubles the amount that the heirs can receive estate tax-free. Moreover, when you set up a living trust, your estate does not go through probate. Now, probate is the legal process of proving that a will is valid. And as we said, this process typically involves lawyers, i.e. legal fees. A judge must approve the probate process. Consequently, there are often substantial probate fees that are due as part of the process. Plus, probate is a very public ordeal that lays assets out in the broad daylight of the public records. Thus, people turn toward trusts to protect privacy. They use them to reduce or eliminate estate taxes and probate fees. In addition, they use them to speed up the asset distribution process to beneficiaries. How trust funds work. For financial and estate planning purposes, several types of trusts are available. But the two of interest to most people are the aforementioned inter vivos trust and the testamentary trust. While similar to an irrevocable trust, a person's will creates a testamentary trust fund. That means it does not exist prior to the individual's death. A settlor, also known as a grantor, is the person creating and funding the trust fund. This individual also determines the trust management terms. The trustee, which is either an individual or financial institution, is the entity responsible for overseeing the trust. With many revocable trusts, the settlor is also the trustee. The settlor establishes the trust fund for the beneficiary. The beneficiary does not own trust assets. Rather, the trustee manages the trust assets in the best interest of the beneficiary, as stated in the trust agreement. The settlor names the beneficiaries and the trustee. Now, beneficiaries receiving money from a trust account will find out how often the money is distributed depends on the stipulation in the terms of the trust. Beneficiaries might receive all of the proceeds in one lump sum or receive payments on a monthly, quarterly, or annual basis. More about living trusts. Living trusts are set up during the grantor's lifetime, and typically the grantor is also the trustee, so they may manage the assets. Professionals often design revocable living trusts to end on the grantor's death, with the assets being distributed to the beneficiaries. While the grantor lives, he or she may buy and sell trust assets and move them in and out of the trust. The grantor reports all trust income on his or her tax returns. When the grantor dies, the trust becomes irrevocable, and then someone values the assets for estate purposes as of the grantor's date of death. Irrevocable trusts. Oftentimes we establish trusts for clients that are irrevocable from the start. Many settlers establish these instruments to keep creditors away from assets. In addition, these trusts can significantly lower estate taxes. With an irrevocable trust, the grantor transfers assets into the trust and can receive income or lump sums according to the terms of the trust. Certain types of irrevocable trusts must file their own tax returns each year. Others simply flow through to the tax returns of the settlor without separate filings. When a person sets up an irrevocable trust without naming themselves as a beneficiary, assets in such trust are not a part of the grantor's estate. Some irrevocable trusts are quite detailed and, unlike revocable living trust, can provide substantial asset protection benefits. That is, when a lawsuit strikes, the trust can shield the trust fund from legal attacks. The irrevocable trust often continues beyond the grantor's death. As a result, it may continue making distributions to certain beneficiaries. In these situations, the tax code considers these distributions as taxable income payable at the beneficiary's rates. The strongest asset protection trusts include the Cook Islands Trust, the Cook Islands are south of Hawaii, and the Nevis Trust in the Caribbean. Domestic courts do not have jurisdiction over our law firm that serves as the trustee in these countries. Plus, these two regions do not recognize foreign judgments that might attempt to reach the trust fund. Beneficiaries and trust funds. Beneficiaries have some rights when it comes to trust funds, but understanding the provisions of the trust is critical. If a beneficiary does not understand how the settlor originally designed the trust and how it operates, he should contact an estate planning specialist. The specialist will explain the process and check to make sure the trust is operating as written. Current beneficiaries of trust funds may request in writing an accounting of the trust from the trustee. These beneficiaries should receive the payments granted to them by the terms of the trust. When a beneficiary does not feel a trustee is acting in their best interest, it is possible to file a court petition for trustee removal. Beneficiaries receiving money from a trust fund account collect their funds as per the terms of the trust. For example, the beneficiary may receive all the funds in a lump sum, or payments are sent on a monthly, quarterly, or annual basis. In conclusion, a trust fund simply consists of the assets within a trust. There are a variety of trusts that hold such funds. The best step is to contact a professional who can discuss your particular needs. We have attorneys on our staff, and our website and phone number is listed below. Feel free to contact us for more information. Please like this video below, subscribe, and share with your friends and family. Thanks for watching. This is The Business Guy.